So now we are looking at different evaluation criterias or different techniques to do capital budgeting. Okay, so we are looking at evaluation criteria for capital budgeting techniques may be grouped into two following categories. One is discounted cash flow DCF criteria. Other is non-discounted cash flow criteria. So broadly, the capital budgeting techniques can be divided into two categories. One category which uses discounted cash flows, and the other category which uses non-discounted cash flows. Now, discounted cash flows means we are going to consider the time value of money. That means we are not going to value the cash flow which is coming in 1 year with the same value, the cash flow which is coming after 5 years, right? So because the time value of money concept says that the money we are receiving early has a higher value. uh, $1 we are receiving in 1 year has a higher value than $1 we are receiving after 5 years, because that $1 we are receiving after 1 year, we can invest it for 4 years and make it much more than $1 uh, after 5 years. So it is not the same as getting $1 after 5 years. So this is why time value of money is a very, very important concept in doing any decision making in finance, including capital budgeting decision making. Also, we should ideally consider the time value of money. So DCF criteria, DCF techniques are more logical, more preferable, more widely used than non-discounted cash flow techniques, which do not consider time value of money. So they are ignoring a very important aspect of time value of money, which is not how we should go about it. But they have certain aspects to them which are useful. So that is where we use them. But broadly, for any logical decision making, we rely on DCF techniques. Now, within the DCF evaluation techniques, we will be looking at net present value technique, NPV technique, IRR, modified IRR, and profitability index. So these are all the techniques which take discounting of cash flows, which take time value of money into consideration. Then we have non-discounted cash flow evaluation techniques, which do not consider the time value of money, such as payback period and accounting rate of return. They have certain advantages which we can use them for, but they cannot be solely relied upon for eventual decision making. Let's talk about the very first technique we have, which is the net present value. So this is a discounted cash flow criteria. That means it considers the time value of money, and this is probably the most widely used, the most popular capital budgeting technique, which is used across the industry. Um, it is the net present value of all the cash flows that occur during the lifespan of the project. It is the net present value of all the cash flows that occur. That means there would be some cash inflows which are occurring, there would be some cash outflows which are occurring. So, first we consider the present value of all those cash flows, and then we net it off. So, cash inflows, present value of all the cash inflows minus present value of all the cash outflows will give us the net present value. So it is the net present value of all the cash flows that occur during the lifespan of the project. The outflows will have negative values and inflows will have positive values. So the outflows will have negative values and inflows will have positive values. Means how do we show them? While doing the calculations, we show all the outflows as minus, as negative value, and all the inflows as positive values. For example, if we are setting up a factory and that would mean investing 10 lakh dollars, so that 10 lakh dollars is a cash outflow. That cash is going out from the company to set up that factory, so that will be shown as negative. That is a cash outflow, that will be shown as negative. And all the cash inflows, the cash flows we are going to generate by uh, utilizing the assets in the factory, those cash flows are we are receiving, so those are inflows, and we will show them as positive value in our uh, Excel sheet when we are doing the calculations. If present value of inflows is greater than outflows, we get a positive NPV. So what is NPV? Present value of cash inflows minus present value of cash outflows, or the present value of all the cash flows. That is NPV. So if present value of cash inflows is greater than present value of cash outflows, we obviously will get a positive NPV. That means this project, this investment is giving us a positive NPV, which means that the value we are getting in today's term is more than value or the investment we are doing in today's term. So that means overall net off, it is giving us a positive value, right? So uh, it is uh, it is a good investment decision if we go ahead with it, if it is giving a positive NPV. Any project which gives a positive NPV is acceptable. If it gives a negative NPV, then project should not be accepted. So what is the decision rule when we are using the NPV technique is that any project, once any investment which we have evaluated using NPV technique, if the NPV is coming out to be positive, that means it is a profitable project, profitable investment, and we can go ahead with it. It is acceptable. If it is giving a negative NPV, negative NPV means present value of cash inflows is less than the present value of cash outflows. So what we are investing, what is going out in today's term is more than what is coming in today's term. So why should we do that project? Investment is higher than the returns we are getting. So that would result in a negative NPV. And as per the decision rule, if the NPV is in negative minus, we should not accept that project. We are losing the value in that case. We are wasting our money in that case. Um, NPV method is scientific and appropriate, considers time value of money. So because it considers time value of money, it is considered to be scientific and appropriate, logical. It is very important that we consider time value of money. That could be considered as a good technique, and we can rely on that technique for decision making. Limitation is it gives an absolute value. So comparison between two projects of different sizes is not easy, right? So what we are saying here is that NPV will come out as a absolute value. For example, NPV is 10,000. Now it is not telling us anything related to the size of the project. It is not considering the size of the project. A small project can also give 10,000 as the NPV. A larger project can also give 10,000 as the NPV. In that case, which project should we choose? Yeah, just by looking at the NPV value, just by looking at 10,000, we cannot make that decision that we should go for this project or that project, right? Because it is just giving us an absolute value. So just looking at that absolute value, we will not be able to decide between the two projects. It is not considering the size of the project. It is just considering the size of the cash flows, which are the net present value of the cash flows it is considering, and it is not going to help us in terms of ranking the projects or comparison of projects of different sizes. Okay, let's look at an example to understand the NPV technique better. Okay, let's read the example. Let's assume we can have the opportunity to start to do a franchisee business for 5 years. So we can set up a franchisee business for next 5 years. That franchisee business would require initial investment of $1.2 million and is expected to generate 3 lakh as returns in the first year, which would grow by 10% every year and also return $2,000, $2 lakh as salvage value after 5 years. Okay, so starting that franchisee business, the initial investment is expected to be around $1.2 million and is expected to generate $3 lakh as returns in the first year. So once we have set up that franchisee business by investing $1.2 million in the first year of its operations, it is expected to generate $3 lakh as returns, which would grow by 10% every year and also return $2 lakh as salvage value after 5 years. So those $3 lakh which we are generating in the first year would grow by 10% every year. So next year it would be 3,30,000, and so on. It will grow by 10 year every year, and also $2 lakh as salvage value after 5 years. So after 5 years, we will also get back $2 lakh as a salvage value. Alternatively, we could invest that money in equity markets with an expected annual return of 14%. So either we can do this business, set up this franchisee business and invest our $1.2 million in that for that franchisee business, or the other option we have is that we could invest that money in equity markets with an expected annual return of 14%. So that means this is the second option we have, that we could invest that money in equity markets, stock markets, and generate 14% return. So we have limited capital, let's say $1.2 million, and either we can invest it in equity markets and with an expected annual return of 14%, or we can set up this franchisee business, right? So we view the franchisee business opportunity and investment in equity markets as comparable investment risk opportunities. So what we are saying here is that we are considering both to be equally risky. Okay, so whether we go ahead with the franchisee business or we invest the money in equity markets, we are considering it to be having the same uncertainty, same risk involved. So we can evaluate them as two opportunities with equal amount of risk. So that 14% could be considered as our opportunity cost. If we go ahead with the franchisee business, that 14% is what we are not going to get as our expected return by investing in equity markets. So if we are doing the franchisee business, that means we are not going to be able to make the investment in equity markets. That means we are expecting to lose out on that 14% annual return which we could have made. So that 14% should be our discount rate while discounting the cash flows. That is our opportunity cost. Okay, opportunity cost of doing this business, of doing this franchisee business, is 14%. We are losing out on that 14% which we could have made through equity market investments. So this is our opportunity cost. And what are the cash flows related to this business? So how we put the cash flows is we make a small table in which we are mentioning the periods as 0, 1, 2, 3, 4, 5. 0 means now, present. So let's say we are evaluating from today's perspective. If today we invest $1.2 million, okay, if today we invest $1.2 million, because we are investing, that's why we are showing it as minus. It's a cash outflow. The cash is going out from the company. So this cash outflows are represented as negative value. And what we are going to get is 3 lakhs as the returns in first year. So this is a cash inflow. So we will show it as positive. All these remaining are our cash inflows. So we will show them as positive values. In the first year, it is 3 lakh, which would grow by 10% every year. So next year cash flows would be last year's value grown by 10%. So this will keep on happening, and also return $2 lakh as salvage value after 5 years. So my 5th year cash flow would be this plus $2 lakh. Okay, so all these are cash inflows. So we are showing them as positive values. These are the benefits we are getting, but we are getting them later, after 1 year, after 2 year, after 3 year, after 4 year, after 5 years. So but this cash investment of $1.2 million is going out today. Okay, so we cannot directly compare these numbers because these are happening at different time periods. We need to bring them all to a present value perspective. That means we need to bring them their value to in today's terms. So what is the present value of those cash flows? So this is the cash flow, and to calculate the present value, we will use this discount rate. So this is the present value of cash flows. What does it mean? That 3 lakh which we are receiving after 1 year is worth only this much in today's terms. Okay, in today's terms, this 3 lakh is worth only this much. This 330 which we are getting after 2 years, in today's terms, it is worth only this much. Similarly, the future cash flows which we are getting later, what is their present value? This is their present value. Okay. Other way of finding out the present value is through discount value factor, in which basically what we do is so these are the discount value factors. That means what is the value of one unit, $1 in today's terms. Okay, so $1 after 5 years is worth only 0.519 today. $1 after 4 years is worth only $0.592 today. So this is the discount value factor. This is the value of $1 in today's terms. Okay, the $1 we are going to receive after 2 years, in today's terms, its value is only $0.769. So this is the discount value factor, and then we can multiply the discount value factors with the actual cash flows. This will also give the present value of those cash flows. So if you see, this and this should match. Yeah, these are matching. So these are two different ways to calculate the PV of cash flows. One is directly discounting the future cash flows using the discount rate of 14%, multiplying raised to the power the number of periods later it is happening, or calculating the discount value factor first and then multiplying the discount value factor with the cash flows. And the NPV would be the sum of all the present values, inflows and outflows. The sum of that would give us the net present value. The net present value in this case is 1,30,510. So that means the NPV is positive. That means the PV of cash inflows, it means PV of cash inflows is greater than PV of cash outflows. That means overall the value of the firm will increase by this much if the company decides to take up this project. Or let's say an entrepreneur is taking up this project that and not investing in equity markets. The other option, if you remember, was we could invest and that money in equity markets with an expected annual return of 14%. So that means the entrepreneur which has decided to let go of that 14% would be in benefit by going for that franchisee business rather than investing in equity markets, because equity markets the expected return was 14%, but here in this franchisee business, even after discounting the cash flows by 14%, we are still getting a positive NPV, right? So even after considering that discount rate, that opportunity cost, we are still, our PV of cash inflows is higher than PV of cash flows. That means definitely we are getting a return of more than 14% by doing this franchisee business. And because these both the alternatives were considered to be of comparable risk, some similar risk opportunities, hence if the risk is same, then we should go with the higher returns which franchisee business is giving us rather than the investment in equity markets. So NPV positive means we should go ahead with this project. So what is the selection or decision making criteria using the NPV technique? If NPV is above 0, then we may accept the investment proposal. If NPV is below 0, then we must reject the investment proposal. If NPV is equal to 0, then we may or may not accept it. Okay, so because there is uncertainty, that's why we are using the discount rate. Discount rate is reflecting that uncertainty, that risk involved with making the investment, and based on that discount rate, if NPV is still coming out to be positive even after considering the discount rate, then we must accept the investment proposal. If it is below 0, that means we are not getting the returns as much as we want because of that discount rate, then we must reject the investment proposal. And if it is 0, then it is up to the decision maker. Do they have other projects which have positive NPV, or this is the best choice they have, best decision they have, then they can go ahead with that. But we should definitely not go with a project which has a negative NPV. So the decision rule is accept it if NPV is greater than 0, reject if NPV is less than 0, may or may not accept if NPV is equal to 0. Let's look at next example for NPV again. The investment in a project is $8 lakh. Cost of capital is 10% per annum. The cash flows after taxes are expected to be as under. Find out whether the project is worthwhile. Okay. So again, we are looking at a project. The company needs to decide whether they should go ahead with the project or not. All the relevant values are given to us. Investment in a project is 8 lakh rupees. So that means this is our outflow, cash outflow. Um, and let's assume it is happening today. So if we are investing 8 lakh rupees today, so we will show it under zero as minus 8 lakhs, and cash flows are expected. So after 1 year, we will get 1 lakh 50. After 2 years, 220, and so on. These are the benefits. These are the inflows we will get by doing this project, and we are looking for at least a return of 10%. Our cost of capital itself is 10%, so definitely we are looking for at least 10% returns. So our discount rate would be 10% uh, in that case. So let's look at the workings. So let's look at how we will discount these cash flows to calculate the NPV. So the initial investment of 8 lakh rupees is shown as minus, that is a cash outflow, so that's why we are showing it with a negative sign. And we are assuming that that investment we are making today, now, at present, so that's why it is shown against zero. And these are the expected future cash flows which are coming in at the end of different periods. So accordingly, we can do the calculation to figure out what is the NPV, whether we should do this project or not. What is the return? Minimum return we are expecting is 10%. Okay, so let's do this. The investment in the project is 8 lakhs, so we will do minus 8 lakhs, and the expected cash flows are 150 after 1 year, 220, 270, 290, and 210. So this is how our cash flow table looks like. Zero means now, present. Cash flows, outflows are shown as negative values. Cash inflows are shown as positive values. So this is our cash flow table. Our required rate of return is 10%, also known as cost of capital, or opportunity cost adjusted for risk involved in the project, that is 10%. And now we need to find out the NPV of the project. So we can calculate the PV of all the cash flows like this, or we can find out the discount value factor. And find out the PV of cash flows by multiplying the discount value factor with the actual cash flows. So the NPV is coming out to be 49,504. So that means NPV is greater than 0. So that means we can do this project. This project is giving us a return of more than 10%, and that is why NPV is coming out to be positive.